and we're all waiting for numbers on that side. Then you could see the price of oil stay in this, that 52 to 54 range for a little while. And that, because of short selling like crazy, especially in Brent right now, hedge funds, commodity funds are beating it up. Not as bad as they did in, April of 2020. If you remember, we went negative pricing because of the nut bars. They're shorting the hell out of it. You may want to delete that word, but and I think we're going to see all-time high ground over 147 which we saw in the summer of '08. And you're even seeing guys like Warren Buffett now saying the same thing. He's now saying, look, if oil moves, it ain't going back to the 100. It's going to go to all-time highs over $200 a barrel. I'm not in his camp yet to stick my neck out that high, but I believe that we'll breach 150 sometime in the next 5 to 7 years. Price solves problems in everything. Right. And at $55, that's not the solution for it. Even with the Canadian dollar at 72 cents, or you get a 1.38 times multiple on it, we're going to need to see 75, 80 to start seeing the industry in Canada, the United States, Norway start to spend a little more money.
Good day, everybody. Today we've got a special guest, Josef Schachter from the Schachter Energy Report in Calgary, Canada, a leading voice on global energy markets. Josef, thanks for joining us.
Oh, my pleasure to be with you.
My colleague Andy and I, Andy Millette, who's here, and I have been looking forward to this for some time, so it's an honor to have you. Let's get into oil. Oil's been out of favor for a while. Why the hate, and could sentiment flip in 2026?
Well, if you go back to the beginning of 2025, the price of crude WTI was $79. Everybody was quite optimistic that we're going to see decent economic growth globally. And then President Trump said tariffs, and all of a sudden the question became, what kind of global economic growth was there going to be? And so we, in January, even before the tariff battle, started seeing U.S. Consumer demand weakening, and we saw China consumer demand weakening. The exports are still doing well for manufacturing, but the domestic consumer market, because of the malaise of the real estate market and other things that were going on internally, higher unemployment for youth, that we saw the price of oil potentially going down, and we had a forecast it would go below 60. We didn't see 56 in the cards, and we didn't see 55 in the cards right now, but we thought they were going to go lower. The fact that we're still not resolved the tariff issue, that's a depressing situation for global economies. And then the other thing is we've got a situation where Canada, for example, is still not got anything going with President Trump. He's quite annoyed with some of our premiers because of their anti-Trump commentary, and a lot of Canadians, don't want to become the 51st state. So there's a lot of issues that kind of impact things. So we thought that the price of oil would come down because demand was softening, and we called for a sub 60. Then, of course, you had the Iran situation, so the price of oil ran up to $79, and then it cooled off thereafter. With the announcement of the Venezuelan seizure and potentially a blockade of Venezuela, they produce about 900,000, just over that, barrels per day. That ship was going to go to Cuba because the deal Venezuela has with Cuba is we'll provide you with free oil. You provide us with doctors, you provide us with military, you provide us with intelligence officers to protect the regime. So that oil would have gone partially there and then to China. So I think people worried about a blockade are now saying, well, maybe this could impact, global supplies faster than we thought, i.e. bring them down. And so the pop we had for the last dollar or two. I think, on the other hand, we're now seeing general stock market weakness. We're seeing mixed economic data, as you saw from labor data. October, a big down. November was a little bit up. I think we're going to see $52 WTI if we see thousands of points come off the Dow and the S&P and the NASDAQ. And again, the Oracle situation is telling you there's concern about the amount of debt going on balance sheet, off balance sheet for the AI game. So if that translates into weaker stock markets, historically, inter-market pressure can bring down oil. And so I'm thinking there's a chance now on my Eye on Energy that I wrote this morning. I said, I think there's a risk of $52 WTI. And going into 2026, that's really where I see things beginning to change. I think first quarter we'll look at sloppy prices, that 52 down to, on the downside, maybe 66 on the upside. But starting in the second quarter, global commercial inventories, I think will start coming down. We'll be seeing SPRs continue to rise because China's still building up their SPR. The U.S. is doing it as well. They added 200,000 barrels in the EIA report today to the SPR. And the SPR is still got a lot of growth in it. Today's number with the 0.2, you have 412 million barrels in the SPR, Strategic Petroleum Reserve, and the U.S. would like to see that at 600. So there's still more to go there. So if inventories build on the strategic side, and we start seeing commercial inventories come down because of demand rise, then I think that's going to be the takeoff in Q2. And I think what we're looking at is where's the growth going to come from? And I think we're going to see the growth come from other Asia, from Africa, and from China to some extent, maybe a couple 100,000 barrels a day. And the increase in capacity is not really there. The OPEC report that came out last week showed that, if you remember, they were supposed to increase production by 143,000 barrels a day in the month of November and December. In December, the data just came out. They had a decrease of 1,000 BOEs a day or barrels per day. The only one of meaningful increase was Saudi Arabia, 54,000 to 10.05 million. A lot of others were down. You had Iran down 19,000, Iraq down 21,000, Nigeria down 11,000, Venezuela down 27,000. So OPEC from field production may be at peak capacity. Where OPEC could raise production even more means they have on-land storage and they have floating storage. And so if you're going to ship oil from Saudi Arabia to China or from Saudi Arabia to Rotterdam, you have to have a lot of floating supply. The problem is it's right now about 300,000 barrels more than normal versus the 1 billion barrels. Now it's 1.3. And a lot of that is the shadow fleets of Iran and Russia. And so, and of course, it was Venezuela, but now they're not going to have that as much. So I think in Q2 we'll start seeing some positive dynamics on the positive side in terms of demand growth. And I'm looking at Q2 a range of $62 to $72 WTI, so back pushing a peak over 70. In Q3, I'm looking 68 to 78, and then Q4 is really where I see things picking up and being 74 to 84. Now you think that, whoa, boy, when we're at $56 WTI, 80 seems like a really crazy number. But if you go to the 2024 data, we traded up as high as $87. And so in a normal period of time when you don't have tariffs and you don't have, any of these geopolitical events, and then if you go into 2022, we were over $100 a barrel. So people don't seem to realize that, $64, if you go to the Federal Reserve of Dallas, they have data showing what's the basic economic break even for our basins in Texas, the different Permian and, the Eagle Ford and all the others, and they need mid-60s. So where we are today is going to slow down drilling programs by companies. When they do their 2026 budgets, they may even drill less than they did in 2025, and they're going to wait for higher prices for oil. Natural gas is different. You got higher prices there now, but we can talk about that later. But my bullish thesis for the long term is this. We have every once in a while a commodity supercycle, and that comes after lengthy periods of underinvestment in the commodity. And we've seen that what that does to cocoa and copper. We've seen what that does to uranium. We've seen that's what's doing in gold and silver now. And, those things have taken off like rockets, and the CRB is stronger. The biggest component in this CRB is energy. And so if oil takes off and we realize that demand will grow by 1.2, 1.3 million barrels per day per year, new capacity may only be 400,000 in the outlier years. Guyana is going to still be a big part of the positives. But most countries will see declines because of lack of capital investment. Look at Mexico. They're not drilling anymore. They used to have a big export of Mayan heavies. They don't anymore. So there's going to be a positive game plan. So we had in history, if you go back from economic history, 74 to 81, Japan became a big exporter juggernaut. We got cars, Toyotas and Datsuns, and we were buying Panasonics. All of a sudden, they needed more energy to fuel that economic growth. And so that push that happened in 74 took crude from under $3 a barrel, and it peaked in 1981 at 36. And that peak was a geopolitical event. The Shah of Iran was deposed, and we brought in the Ayatollahs, and they immediately said, we're not selling oil to the bad guys, being the West. And then, of course, from 80, when you got to, $36 in 81, Paul Volcker said, oops, we got too much inflation. Didn't have a president in the White House who said boo. And all of a sudden you had interest rates of, mid-teens and on the long end and 21% on the short end. And of course, inflation broke. Price of oil came down to $10. And then we had a trading market. So there was an investing market from 74 to 81. The next investing market didn't start till 1999. And that was when China said, we will allow capitalism under the communist umbrella. And so they were producing about 4 million barrels a day in 99, consuming about 3.5, exporting a half. And then all of a sudden, capitalism took off, exports took off, jobs took off, people moved from rural into urban, and they started growing to 14, 15, 16, now 17 million barrels a day, only producing still 4 million. So the imports are significant. But that juggernaut from 1999 to 2008 took the price from $10 of oil to 147 in summer of 2008. And then what happens? The central banks say, oops, and we have the financial crisis. And then we went into another trading market. In 2020, that game started again. And in 2020, the new players are, if we know that we want to have a grid that's rejuvenated, if we want to have data centers, if we want to have EVs, we're going to need lithium, copper, nickel, all those raw materials, rare earths. It's a big game now in rare earths. And so you're going to need a lot of development in Africa and in South America and other places. And many of those places, they don't have the infrastructure. That's going to have to be built. The government's going to have to see a rate of return. The people working there are going to have to see a quality of life improvement. They're going to want running water. They're going to want electricity. They're going to want better schools. They're going to want to go from bikes and mopeds to driving cars. All of that is a massive increase in the demand for crude oil. And that's why I think we're going to see a cycle that lasts into the early part of the next decade. And I think we're going to go from 105 million barrels of consumption in 2025 to maybe 112 million barrels by 2032. And most of that growth will be from the non-OECD, while the OECD will see declines because of climate impact, more, car, efficiency requirements, more, ending of using diesel, switching to natural gas, for the fuel that's needed. And so all of that's going to mean that the non-OECD is where the growth is. And I think we're going to see all-time high ground over 147 which we saw in the summer of '08. And you're even seeing guys like Warren Buffett now saying the same thing. He's now saying, look, if oil moves, it ain't going back to 100. It's going to go to all-time highs over $200 a barrel. I'm not in his camp yet to stick my neck out that high, but I believe that we'll breach 150 sometime in the next 5 to 7 years.
Yeah. Steve, if I could jump in,
Wow.
I got like
Please.
several follow-up questions. Wow, Joseph, you answered a lot of them, but I still want to ask them if you would.
Sure, my
Uh,
pleasure.
and that was just fantastic. Okay, so I look at the oil market, and number one, I question why is it so low? And I think you addressed it just with some softness in economic data and a potential recession or sell-off, if you would, in the S&P or whatever have you. But I see it so cheap, and it's just mind-boggling to me. No, this is just a statement more than a question, but it's just that it's so cheap. But it leaves a really, I think, a great opportunity for investors, if you would. But really, my question is you mentioned, I want to say 100, well, I don't want to give the wrong stats, but we're going to need more, we're going to be consuming a lot more oil, really starting the last quarter, going into the next decade, if you would. So, talk to me a little bit about where are you, and you mentioned this too, but I want specifically where are we going to get that spare capacity? Because nobody, again, it's not like you can turn on the light switch to start drilling. Correct me if I'm wrong about that. It's a process and it takes time. The Permian Basin's plateaued and the oil sands in Canada, again, correct me if I'm wrong, but they need around 60, if not higher, to make it economical. And I'm not sure that oil sands have it either. Where's that spare capacity specifically? Where's it going to come from?
Well, price solves problems in
Right?
everything. And at $55, that's not the solution for it. Even with the Canadian dollar at 72 cents, or you get a 1.38 times multiple on it. We're going to need to see 75, 80 to start seeing the industry in Canada, the United States, Norway start to spend a little more money. We're going to need over $100 to really attract the capital for the infrastructure. You need pipelines, you need more refineries, you need all of that stuff. And then what happens historically is, capital is disciplined in the beginning, and then all of a sudden, when there's high prices, then money gets thrown at it. As you remember, going back, the last Permian boom, and all of a sudden there's more capital coming in, and cost pressure went up, a drilling rate went up. And then, of course, you put too much out there and build too much. So I think it's going to be a slow process that, 70, 80, then 80, 90, 90 to 100. And a lot of the new production is going to have to come from the third world. It's going
Yeah.
to have to come from offshore West Africa. It's going to have to come from Brazil offshore. All of these take a lot of time. Just think about the discoveries offshore in Namibia and how long, they've announced that they have a, attractive resource there, but they haven't got the FIDs. They haven't figured out how many tens of billions they need to spend. Just think about, the cost overruns of Trans Mountain, the cost overruns of Coastal Gas Line in Canada. These things
Mhm.
take time and a lot of money, and so you can't turn on 3, 4 million barrels of new production in a year. It's going to take multiple years. People talk about Saudi Arabia maybe having 12 million barrels of capacity. They in the field, they've never really produced more than 10 and a half. What they do is to punch it up to 12 is when they get pressure from the world, and then they drain down their inventories onshore and offshore to get to that 12 million. But it's not sustainable for more than 6 months. So the
Mhm.
industry, I think, is going to be in a tight situation in the next year or two, and then the price will go up to attract capital, and then capital will take time to be deployed, and then the infrastructure that's needed once you have a discovery will have to be built, and all of that takes an enormous amount of time. That's why these cycles are so long and so profitable. And I think this cycle lasts into the 2032 period or whatever,
Wow.
all-time highs in the price of oil. Here's how cheap things are. You can buy stocks today under 2 times cash flow.
Yeah.
How many businesses around the world can you buy at 2 times cash flow? That's on depressed cash flows.
Yep.
Second, companies are trading based on 2024 NAVs based on low commodity prices.
Mhm.
Many of them are trading at a quarter to a third of their NAVs, net asset values. They're trading at right now at the PDP, proved, developed, producing. So if they don't spend another penny and just run down the reserves, that's what the market is paying today. They're not paying for proved, not producing, and they're not paying for probable. Historically, at market tops, they trade at those levels, And on a price to cash flow, instead of 2 times cash flow, they trade at 7 to 8 times cash flow.
Right.
So if you're going to have a boom in commodities, you're going to have an expansion in cash flow multiples, you're going to have a growth in NEV. That's how you get 5 and 10 baggers. And I think this cycle, just like we saw in 74 to 81 or 99 to 08, you can just go through the history books, pick the companies you want, be it the big majors in the States, be it the more entrepreneurial names. There's going to be a lot of M&A and consolidation. We just saw Ovintiv come in and buy out New Vista. We saw Ovintiv come in and buy a big asset play from Paramount. And then they just signed a deal with Cedars to produce a half a BCF a day of gas into that new LNG plant. So the consolidation will continue. You've seen Exxon be a massive consolidator in Texas, and I think you're going to see more of that. And I think the one thing people have not looked at is offshore drilling. And I think that some of the biggest reserves will be found, be it in the North Slope of Alaska, with the president now authorizing drilling there.
Anwar.
Is there Anwar? Is
Gulf
there
of
gonna
America.
Yeah, Gulf of America. There's so much oil there that and the companies, they just had, I think, an auction, and they raised $300 million. And I think Woodside was active, Chevron was active. There was quite a few companies went in there because they see the big potential. And again, with modern technology, there's 3D and there's 4D technology being used. We now can drill deeper than we ever did before. And so there's lots of new technology being brought to bear that will help us find new oil. Everybody talks about peak oil and, the bears. And the reality is I don't see peak oil simply because of the technology side. If we're going into the issue of the Canadian oil sands and thermal oil, we are producing about 6.1 million barrels a day. We're the fourth largest producer in the world. The United States, number one, 23.4. Saudi Arabia, 10.0. 9.5 for the Russians. We're 6.1. Then you go to China at 4.3. So we have the ability, if we had the takeaway capacity, and that's the big if, we could probably produce another 2 million barrels a day. That's how big our resources. We have the second largest heavy oil reserves in the world after Venezuela, the Orinoco Basin. So it's a great opportunity. Foreign companies withdrew from Canada, because of our political system under the Trudeau government. Now that the Carney government is talking more positively, especially about natural gas and LNG, oil still is a difficulty with our First Nations, and also the province of BC doesn't want oil tankers on the coast because they're worried about environment. Remember Exxon Valdez? They're still nervous about that and the cleanup procedures, et cetera. So I think natural gas has a big boom opportunity in Western Canada. On the oil side, TMX still has a little room to take more oil. And then, of course, you heard Enbridge talking about expanding, tweaking their system by 300,000 barrels into the States. And then, of course, there's rail, which, of course, nobody likes rail. It's one of the most environmentally stupid things to do, but there's no law against it.
Right. Steve, I got many more questions. I want to talk about natural gas, but I want to
before we go into natural gas, I do want to ask another question. We'll jump into natural gas after, if that's okay. You mentioned being bullish on oil from 26 or so to 32. How closely is that tied to the 5-year plan and for offshore drilling? And then do you see certain types of companies being uniquely positioned to benefit from that?
Well, in terms of the offshore, you need to go to the guys who are very good at it. So Total Energy is good at it. Chevron is pretty good at it. ExxonMobil has proved that with Guyana. So those guys who have that expertise to go after those multi-billion barrel pools that can produce 500,000, 1 million barrels a day, Total is in that group. So look around the world, on the west coast of Africa, who's drilling there, who's drilling in Guyana, who's drilling in Thailand. There's offshore Thailand is big successes. And so I think you want to have not only the companies that are drilling, but you want to go after the drillers as well. Because offshore drilling has been like onshore drilling. The prices are just barely covering the costs. But if activity picks up, all of a sudden the rig count doesn't build. All of a sudden the price of the day rate goes up and the margins take off for the rig companies. And I think onshore and offshore rigs, should do very, very well. And so we have on our recommended list a number of onshore Canadian drillers for our recommendation. But for people down south in the U.S., you've got a lot of opportunity in the Gulf of Mexico. As we talked to Anwar, Guyana still is very active. Find out who those guys are. Is it Diamond Offshore? Who are the players that are drilling? And take a look at them. Some of them might still have debt issues, so they're working away on that. But longer term, I think they're going to make a lot of money for investors, as they have in the past. Just pull out the charts from 99 to '08 on all those stocks and just say, okay, where was the leverage? Who had better balance sheet? Where did the market go when they wanted to own those kinds of names? And I think you'll find some very good, attractive ideas. I'm not in that area. I don't cover it specifically, but you can find people who have that knowledge base down south to give you support and advice.
Andy, go ahead.
Yeah, okay. So before we go to natural gas, just anecdotally, I was in Alaska. I'm from Alaska, and I remember Exxon Valdez very well. And also, I remember the 2008 run-up, if you would, in the price of oil. I was long oil, and then it just got way too hot for me. And I thought it was going to $200 a barrel, but it just got way too hot for me. And I remember the epic crash here. Just anecdotally, I thought I would say that. But you talked about the opportunity, and not specific names is my question, but you talked about the opportunity in Canadian oil companies, small Canadian oil companies. I couldn't agree more with you, but talk a little bit about that in a value sense. These guys are so cheap. Looks like an opportunity to me, but comment about that.
Yeah, I'm just pulling out the data in front of me. There's different ways to go about it. There are Canadian companies focused on natural gas and natural gas liquids. There are Canadian companies focused on oil and the oil sands and SAGD. You have the Canadian royalty income funds, where they have royalties in Canada and the States, and then they pass on big dividends. And then you have the service sector, and then you have the Canadian companies working internationally. So we look at all of them. We have companies on our list that fit all of those bills. So let's take a conservative investor who would like to have dividend income and some growth. So in that case, okay. So in that case, you've got Freehold Royalty, which has royalties both in Canada and the United States, ticker symbol FRU. I don't know if it's .TO or whatever for the States, but the Canadian symbol is FRU. They produce about 16,000 BOEs a day. They pay 9 cents a month, so $1.08 in dividend, 7.1% dividend yield, and it's a $2.5 billion Canadian market cap, so not a small one, and it's pretty liquid. So that's another one for people to take a look at. Another one is Topaz Energy, which was a spin-off from Tourmaline Oil. Going from the royalties to the natural gas companies, the premier company in Canada is Tourmaline Oil. The team that was there did Berkeley, then they did Duvernay. Each one was taken out by a major. Shell took out Duvernay, I think. Anadarko might have taken out Berkeley. I'm not 100% on that in terms of my recall. But Tourmaline is a company that is producing about 635,000 BOEs a day, 77% natural gas. It pays a 50-cent quarterly dividend, so that's $2. And it also pays special dividends when it has excess cash flow. So that's a nice one for it. It's a company with a $25 billion Canadian market cap. And just to give you some targets, our bull market peak target for Freehold is $24. The stock's trading, in the 14 range. So with that total return dividend, that's nice total return. If you go to Tourmaline, we think the stock potentially has an upside of 150. So it's trading in the 62 range or so right now, or 60 range, sorry, right now, just looking at the chart. Markets are down today, as we know. And so 150, so, potentially a big upside there. They also grow by acquisition, so there's some things that could do there. The other one I like is a company called Birchcliff. And let me go back to, the one other feature we use is Net asset value, I think I mentioned that, that's important. In the case of Birchcliff, we're talking about a $7 stock that has 2024 NAV done by a reputable reserve engineering firm, $22.54. So you can see that you're trading at a third of your NAV. So we have a $25 target going out in the cycle. So these are the kind of bargains that are out there. And this company produces 80,000 BOEs a day and has a $2 billion Canadian market cap. So there's some bargains out there galore. So Tourmaline and Birchcliff would be my natural gas preferences right now. Then you go to oil. Strathcona Resources is producing about 180,000 barrels per day, 116,000 barrels a day in Q3. They're talking about 180,000 is their goal. They have a small dividend, $1.20, but they have an NAV of $77, and they're trading, in the 40s. So, and of course, if the price of oil goes up, then you're going to see that. One of the oily names that we really like is Surge Energy.
Yeah.
The company produces about 23,622 barrels, 88% liquids, a $700 million Canadian market cap. It pays a monthly dividend equal to 52 cents, a 7.3% dividend yield. Just for full disclosure, I own both Tourmaline and I own Surge. So just for full disclosure. And there's another one that we really like, Whitecap Resources, which is 61% liquids. They pay a 73-cent dividend paid monthly. That's a 6.3% yield. And again, full disclosure, we own that one. So my wife likes the dividends.
Yeah. Full disclosure, I own Surge Energy. Thank you for talking about them. Steve, what do you got? Follow-up question.
Well, when we had Rick Rule here, we're talking about the relevance of oil. And, most people look at oil going out of style, out of vogue in the next 10 years, whereas Rick would probably see the timeline more closer to 30. And that's not being properly accounted for in the pricing. What are your thoughts on that?
I'd even be more optimistic than him. I think that, if we're going to continue to drive cars, EVs work in major, urban centers. I will never buy one because my family, my kids live in Edmonton. That's a 300-kilometer distance from Calgary. Now, if you know what happens in cold weather, which we are having here, we had minus 20 degrees Celsius a few days ago. I couldn't get to Red Deer halfway on a charge. So until the technology gets to the point where you can go to, you can go from Calgary to Edmonton, charge in, quickly find a charging station in Edmonton before you come home, go get a Starbucks and come home. We can't, it's not going to be a legitimate methodology of transportation for a long time to come. And so I'm in the camp that oil will be needed for a very long, long time. And if you believe that we're going to need the third world to bring on the nickel, the lithium, the rare earths, all of that, they're going to be using more and more gasoline and diesel and jet fuel. And so I'm in the camp that it's going to be much, much longer. We'd all like to see the Star Trek world with what are the
Beam me up.
Jetsons.
Yeah, all that kind of stuff where, transportation can be, will transport you up, all that kind of stuff. We're far from all of that. It's nice, to read it in science fiction, and we'll be watching Avatar soon, so that should give us the new one. So that should give us some kind of nice ideas from the sci-fi world. But the reality is, we're going to be, in my lifetime, I don't see it, in my children's lifetime, I don't see basic use of oil and natural gas. I remember as a kid, we have a coal dump in our backyard into our coal bin in our basement in Winnipeg. And then, then we went to natural gas. We're still with natural gas. And with the, methane emissions that are being changed with the very strong, we're going to have a carbon capture system in Canada. We're going to be still using these as efficiently and as cleanly as possible. And just because of the desperation around the world for electricity, you're seeing countries reverse their stance on closing coal-fired facilities. U.S. is doing it. Germany's looking at it. Other countries in Europe, China is still
Hmm.
building them. India is still building them because they need electricity. And can they afford the imports of LNG versus building their own coal and having that as a positive impact of jobs, et cetera, on their economy? So, people are stubborn, saying we should get rid of coal, and all the climate environmentalists have been throwing that at us. The reality is economics balance at the end of the day, and if countries cannot afford the imports of the cleanest fuel, which is LNG, they're going to go with what they need to make their economies function.
Joseph, well said. So talk about natural gas more, if you would. So just so you know, uh, this was late August, early September. I started buying some companies in natural gas. I wanted a lot of torque in the companies I was buying to the natural gas price because I was looking at the curve, if you would, the natural gas curve. But talk about that. Do you see natural gas continue? We hit a bottom again around that time. It is cyclical depending on the season, but it's also cyclical with the commodity super cycle, if you would. But my question is, do you see natural gas continuing its upward trend? It looks like we had a bottom here again, I think, but I'm not going to call that. And what would you advise people to do in evaluating a company? Do they want torque or do they want, and I guess it depends on personality, but do they want dividends?
So you're right that we had in August $2.65 for NYMEX at the low. We had that little spike up to 550 a week or two ago. We're about $4 right now. One thing that really was encouraging for me last week was the EIA release, and if you recall, it was 177 BCF withdrawal, of which 58 was in the Midwest. 45 was in the East. I've got the data in front of me. South Central down 55. And compared to a year ago volumes, it's down 0.7%. The one that matters to me is storage in the States going for over the 5-year average was up 8 or 9% not months ago. As of this report, yet last Thursday, it's only up 2.8%.
Wow.
So if we start pulling that down below the 5-year average, it tells you two things. Domestic consumption is picking up. LNG exports are picking up. I don't know if there's 17 or 18 BCF now going out of the Gulf of America, and we're not going to call it the
It's
Gulf
so
of
funny.
Canada.
No, we're joking. We're jest, but go ahead. Go ahead. Not really, but jest.
And I think that the industry at $5 starts attracting coal as an alternative medium. So, can you
Hmm.
have a spike on extremely cold weather to $8 or $9? We've seen that. If you go to 2022, we got up to $10.04. I've got the chart
Yep.
in front of me.
I
And then
was in
in
it.
2014, you got up to 649. So cold weather spikes. If you have two,
Hmm.
300 BCF drawdowns in a single week, but the industry doesn't need that. The industry needs $4 to $5 on a consistent basis so they can afford to do the drilling. And if you go to the data that just came out, last week again on from Baker Hughes, the U.S. rig count is down by 7%, but the gas rig count is 127 rigs, up from 103, up 23% because of the LNG situation. You've got to provide the natural gas for them to continue to grow the LNG takeaway. And the Canadian, and then you go into the U.S. domestic market, you've got a lot of LNG or natural gas needed to fuel those data centers.
Right.
Because if you are in a state and your grid is full, you don't want a data center coming in because that means you're going to be paying higher prices as a consumer. So the many states and in Canada, many provinces are saying, you want to bring a grid in, you want to bring a new a data center in, you find your own power. Now, we all are talking about modular nuclear reactors. They're far away in the future. So what it's going to be is where they're going to go near a source of natural gas, be it the Marcellus, be it the Haynesworth in the States, be it the Montney in Canada, be it southern Alberta with shallow natural gas, and they're going to do contracts to lock in that gas for 25 years. The deals that are being done now are NYMEX related. So you get US prices in Canada with low transportation costs. It's an advantage to the producer. It's an advantage to the data center. And the other thing is it's cold here. You don't need to heat. You don't have to worry about heat so much.
Yeah. Go ahead, Steve.
Joseph, are you seeing infrastructure bottlenecks, and where do you see the opportunity for that?
Well, I think you need to look at each of the commodities separately. So let's go to natural gas. We have Coastal Gas Pipeline, which is going to be able to feed a lot. Right now we have 1 BCF on LNG Canada has a 2 BCF train. 1 BCF, one train or one part of the train is working. The second part is being ramped up. They will be at 2 BCF a day sometime during Q2 of 2026. Then there's other projects, Cedars, Kissimmee. You bring all those on by 2028, 2029. You double the expansion of LNG Canada when they do FID in the coming months. We'll be producing 8 BCF of LNG for export. We only produce in the Western Canadian Basin 18 BCF. That's a massive growth opportunity. And so I think natural gas has a real home run potential, and you need attractive enough prices. We're right now, I think, 3.25 for AECO. We need $4-5 for AECO. So while you may have $4 or $5 US, we may have $4 or $5 AECO. There's a transportation issue if you want to sell it to the States. But moreover, we also have a 1.38 difference in the Canadian dollar, our 72-cent dollar versus the US par comparison. So I think that natural gas is a great story, and my personal portfolio is focused more on natural gas than it is on oil. On the oil side, we do have room on the TMX. We still have room on Enbridge potentially. And could we get to 7 million barrels a day at the end of this decade if government regulations approve, First Nations buy in? You need everybody on the table. There's also talk now, if we can't get a pipeline to the West Coast, maybe Churchill, Manitoba could, because 8-9 months of the year now, there's no ice to break through. And the Canadian government's going to start spending money on icebreakers, as the U.S. government is planning to spend money on icebreakers. Buy them, what is it, from Norway, I think, or Denmark? Norway, I think that's where they're going to buy them from. And then I think you're going to see, less of a growth rate, but commodity prices going up, which makes it a very attractive business. So again, if you have a white cap with a very nice dividend, and you have other companies that are growth, so we have some of our names that are growth stories that do not pay dividends. But I can give you a few examples of that. I'm just going to go into the percentage of liquids, and I'll go give you that. You can see Whitecap 61% liquids, Bonterra 51% liquids, Gran Tierra, which operates in Colombia, Ecuador, and Canada, 96% liquids. Marin Energy, which is offshore Africa. Remember the old Africa oil? We cover that because they're a Canadian company and they're looking internationally, 98%. Obsidian Energy, which is in the Cardium and in the Clearwater, 71% liquids. Surge Energy, the one you talked about, 88% liquids. Valeura Energy, which is offshore Thailand and doing 23,000 BOEs a day, 100% liquids. And then you can look at in-play oil, 60%, Questair 52, Rubellite 72. So there's a lot of choices for the oily names. And then, as I mentioned earlier, you want to have access to the service sector. So Total Energy has compression, and it's got drilling rigs, and it's got service rigs, and it operates in Australia, United States, and Canada. You've got Precision Drilling, which is one of the biggest drillers in Canada, the biggest driller in Canada, big in the States, big internationally. Ensign Energy, big in Canada, the States, and internationally. CES Energy, the fluids that are needed when you're drilling, the fluids that are needed when you're producing the oil to get the maximum return on the oil. So there's lots of different places to go. In my case, I like some dividend income, but I also have a growth side to the portfolio simply because the upsides could be 5 and 10 baggers. The bigger companies might be doubles or triples. Nothing against that if it happens in 5 years. Do it to me every day. I'll be happy with that. But I was there for 74 to 81. I was there for 99 to 08, and a lot of money was made. And so the key thing is don't overstay your welcome. And what we do at our firm and with our research is we look for those period of times when we have the super cycle, which we said started in 2020, but we look for the times when there's corrections. And there's always corrections in every bull market. And there's 3 measures that we look at that we use for our buy signal. One of them is the price of the commodity gets way below the break-even point. And again, Federal Reserve Dallas says you need mid-60s for the
We're there
U.S.
now. Yeah.
Then you go to the actual level of the index. So the S&P TSX Energy Index, which is trading at 290 today, it was at a high of 318 just 2 weeks ago. I see that going below 240 before it signals a buy signal. The last one is the S&P Energy Bullish Percentage Index. When it's 80, 70, 80, or 90% at the real high, that tells you everybody's joined the party. Everybody's invested. Where's the new money going to come to drive prices higher? If you get down below 10%, that's a buy signal. You get down below 5%, it's a table pounding buy signal. In April of 2025, it got to the lowest reading in history, 0%. So it made
Wow.
it very easy for me to say, we have a table pounding buying opportunity because I got all three of my checks check marked, and the best one was the S&P Energy Bullish. Just to put that in perspective, it was 70% about a month ago when we had the lofty movement in the market. When I took the picture of it on Friday of last week, it was at 59%. This morning, it's at 50%. So
Wow.
if we get a hit in the market here and a pullback, as I mentioned in the general market, the AI problem, there's concern about economic activity, a bad number out of Europe, a bad number out of the States, and we're all waiting for numbers on that side. Then you could see the price of oil stay in this, that 52 to 54 range for a little while. And that, because of short selling like crazy, especially in Brent right now, hedge funds, commodity funds are beating it up. Not as bad as they did in, April of 2020. If you remember, we went negative pricing
Right.
because of the nut bars. They're shorting the hell out of it. You may want to delete that word, but the reality is, I think that we're getting to an excess on the negative side, and if we can get the prices down to attractive levels, and if I just look at today's action, let me just see if I can move my pointer.
Did you want to do a share screen?
No, I'm just trying to go through and just get percentages. You've got some stocks 1% and 2% lower today. So like yesterday we had companies that were down 3, 4, 5%. And so today the index is at 290. And the low today was 288, the high, where it is now, but it was 317 2 weeks ago. So I think that we're going to see, maybe another 40 points, 50 points off. That could happen. Maybe we don't have a Christmas rally this year. Maybe we have a weak January. And that gives us the next buy signal. And I think that is when I think I'll be sending out a table pounding buys, some new recommendations, reiterate those that are the cheapest on our run. We cover 31 companies, Canadian companies under NI 5101, because we want the regulatory coverage. And the team does a very good job. The April call is probably the one that got you interested in having this chat when we said buy. And then in Canada, the people loved it when we said it's 79. Some of the oil companies weren't happy with me, but when we said
So.
the data says it's going to weaken, they said prove it, and the reality is it turned out to be the case.
Yeah. Could I ask you about one specific stock that I'm invested in? Would that be okay?
Of
And
course.
perhaps, yeah, Pinecrest Energy. I started buying them in late August, early September. Been very happy. They've had quite the run, but it was really, again, a play on natural gas. But yeah, comment about them if you're familiar with them.
Yeah, I talk to the company regularly. Phil Hodge is the CEO. 358 million shares outstanding, 326 million market cap, a 2-cent dividend, so it's pretty small. 81% natural gas. In the third quarter, they produced 20,376 BOEs a day. They have potential for oil in the Glock, which is upside for them. What I like about them is they now have 3 different attractive core areas. They just had, low decline natural gas in the southern part of the province. They now have 3 different good core areas. And also they're getting their balance sheet in order after an acquisition they made 2 years ago, paying that debt down. And then the other thing I like about them is they're starting to do IR. A lot of companies in Canada are because of the low prices are in their bomb shelters and are not willing to raise the flag. I give Phil credit, as with Paul Coburn, that they're going out there in the good days and the bad days, telling the story, telling why what they're doing during those tough times with low prices and how they're making their companies as viable as possible. And they talk about a growth wedge. When the price of oil cooperates, we will have a growth wedge. And in the meantime, they're paying you. Of course, Surge is paying you better than PNE, but again, PNE would be able in a growth. If we get to $5 gas and we have $90 oil, the liquids portion will go up. From 19% to maybe 25 or 30, and that'll kick in a lot of new cash flow, and then they can consider increasing the dividend. But in the meantime, the key thing when I look at a company is, number one, do they have great management? And the case is there. Second, do they have land where they can drill for many, many years? Three, do they have the balance sheet to execute on that? And fourth, do they have areas where they do not have any problems with First Nations?
Mm-hmm.
And so if all of those are and of course, takeaway capacity for that product. So they don't have any of those problems in either of Pinecliff or Surge. I'd keep an eye on Tourmaline, the biggest name in the industry, and one that, has got a lot of U.S. following. And then I'd keep an eye on Birchcliff. I think that's a name that I'm a fan on. And most of these companies, if you approach them to have them on the show, you could ask them to come on and tell their story. They're all very accessible. If you want to use my name, go ahead. Let's say, say to Birchcliff, say to Phil Hodge, can you come on and tell your story? They can do it from their office in Calgary without traveling, and you get a very good interview. And Phil Hodge is probably one of the best experts in Canada on the natural gas world. He just came back from a conference in the U.S. He does I think a monthly or quarterly blurb talking about the whole macro side of natural gas. So you might want to go to his website and sign up on it for that email, because I find it very, very valuable. And he's one of the best or better CEOs at running a company. And 20,000 BOEs a day is not too small.
Well, about Phil, I had him on the show actually. He actually came down marketing the company down to Atlanta where we're at. And I got to say, I put him through the hot seat and was just throwing fastballs at him, or in Canada, hitting the hockey puck at him as hard as I could. And he defended really well and hit the ball out of the park, for a baseball term. He was just fantastic. Full disclosure, I am an investor in both Surge and Pinecrest. So thank you for
And
that.
I would get Paul Coburn on.
Joseph.
Sorry.
No, go ahead.
I would invite Paul Coburn on. I would go to Birchcliff, to Chris Carlson. I'd go to Mike Rose at Tourmaline. There's so many good companies in Canada that are not they're so much cheaper than the U.S. equivalents.
Yep.
And people just don't care. And historically, when the price of oil gets up and when we don't have our political problems like we did with Ottawa in the past, foreigners would come in and they start with the bigger cap, then they'd work their way down to the smaller names. And the biggest upside is always in the small ones, the 10,000, 20,000, 50,000 BOEs a day, because they can double in size over the 5-year period with the drill bit. And then the market all of a sudden, either somebody will come in and knock on the door and say, we want your assets on our balance, on our portfolio, and they get a good takeover period. We had that with Varen. We had that with, other companies. New Vista, was $11 stock, take out at 18 in less than 9 months. So there's a lot of opportunity here. And, if you guys have the system you do for, podcast system, if you want to chat about names with me, we can do that. And if you guys want me to be on once a quarter or whatever, I'm happy to do it. And I love this gig. I love it. I love the
No, I
business.
can tell, and we love
It's fun.
having you. We love having you. It's a lot of fun.
Just
I don't have any more questions. Steve, did you want to?
no, just Joseph, if you'd be so kind as to give us just a quick rundown on what you offer, what the Schachter Energy Report, what people get, and how it benefits people, and as well as your website and how people can find you.
Yeah, there's two things. Let's go. There's three products that we have. One of them is the SER, which is our 31 companies that we cover, and we cover it for a retail format. I used to be on the institutional side, and you had G&A per BOE and op costs per BOE. Individual investors don't give a crap about that. They want to know, why do you want me to buy the stock? What's a good price to buy it at? Keep me up on the good and the bad. And we have a section called Balance of Evidence in all of our research. And then where do you think the stock could go in a bull market cycle, which is all what we prepare there. The second piece we do is called Ion Energy, which we have on Substack. And also our people who are the SCR product get it included, so they don't have to pay extra for it. So it's on Substack, and that's the macro piece I did today, which talked about the hedge funds being short sellers and why I thought there was a chance for a $52 WTI. The third thing we do, and you can talk to Phil or Paul about it, Andy, we do a conference every year at Mount Royal University in Calgary, and we have high net worth individuals coming, like there's 700 that came this year on October 18th. Our next conference will be October 17th. And we have every company from a Tourmaline on the big side to Surge and Pine Cliff, et cetera. The drillers, all of that, the names, a lot of the names we've talked about, Birchcliff, it's Yangara, others. And we get the companies to come and do 20-minute, 25-minute presentations. It's a full day on Saturday, October 17th, 2026 is the next one. And then they have booths. And so getting a chance to talk to the CEO, be it Phil or be it Mike Rose at Tourmaline or Chris Carlson at Birchcliff, and ask them questions. Retail doesn't get that opportunity anymore. It used to be you had annual meetings and you can go and talk to the CEO. Maybe you got a question in, but here they come, they spend time at the booths. They know retail got them into the business when it was retail investors that were their supporters. They want that face time. We really are filling the vacuum. The industry spends so much money on institutional marketing. They don't spend so much on individual access points. We provide effectively a monopoly where we bring people in from not only, it used to be just Western Canada. Now we're getting people coming from all around the world because the podcast and social media work we're doing has now got us, investors all the way from Australia to Japan, even in Saudi Arabia, because we make some crazy calls and sometimes we're right. And, and that attracts people when they're looking for somebody who has something out of the box. And if they can document why they believe that, and in the end it comes through, we are in a lot of points. But we lost 3 companies this year to takeovers. We lost New Vista, we lost Kuwaitno, and we lost Step. So we're in the process of looking to add new companies. I've had a watch list of 11 or 12 names, and we're going to pick the best of them and add them to our research coverage. So for the people, can go to www.schachterenergyreport.ca. We have a holiday special on now, so conveniently you can save $100 on the $9.99 for it. It's, I think the code is HOL25, holiday 25. HOL25 is the code to get the discount. And we'd love to have some new people follow us. And and then the benefit is, if you need macro input, we have that. If you want individual ideas with dividends, you want individual ideas, large cap, medium cap, our team puts on that product right across the board. We're in the process of expanding our team. I'm trying to get a G&G specialist, so whenever they bring out the logs, which I have no idea what they're saying, I want somebody on my team to look at it and give them the tough questions, as Andy did to Phil. I don't know if Andy can read logs, but I sure can't. I'm a financial guy. So you want that talent on the team. So we're looking to grow our team as we grow our subscriber base. And if you guys can help us, fabulous.
We'd love to have you on anytime or help you in any way.
Joseph, would love to have you back first quarter Love to have you back first quarter sometime, but your thoughts, your time have been very insightful. Everyone, please do your own due diligence, and one of the ways you could do that is reach out to Schachter Energy Report and see about their services. And again, Joseph, thanks so much for your time. I'm just Steve Yang here with Andy Millette here, and we'll put Joseph's website as well as his Substack and show notes. We'll have all that. So everyone, stay smart, stay curious, stay disciplined. Joseph, we had a great time. Thank you so much.
Thanks, Steve, and thanks, Andy. You guys take good care and have a good Christmas and a happy New Year, and we'll look chatting in the new year.
You
All
bet.
right. Thanks so much, guys.
Bye bye, guys.
Bye.